Welcome to Bloomberg ETF IQ. I'm Scarlet Fu. Katie Greffeld is on assignment today. Let's get to the biggest stories right now in the nearly $22 trillion global ETF industry. U.S. stocks are sitting at record highs even as investors wait on Iran to respond to the U.S. proposal to reopen the Strait of Hormuz. We will speak with Brittany Christensen from the Tidal Financial Group as a new fee tied to certain ETFs frustrates some smaller issuers. And also this hour, an exclusive interview with San Francisco Fed President Mary Daly, with the central bank set to deal with higher inflation as well as a leadership transition. As always, Eric Baltrinas from Bloomberg Intelligence is here with us, and he gets us started by looking at flows. Eric, what do we have?
Yeah, Scarlett, very bullish out there. You know, March showers brings April flowers. That's my new rhyme here, because in March, which is historically bad under Trump presidency, you had COVID, you had tariffs, and then Iran, but it's really short-lived, as most of these things are, and you can see the flows came roaring back in. This is just for the week, but here you have the three amigos, right? VU, SPY, IVV, the three big S&P 500 ETFs. This is for retail, this is institutional traders, and this is models, right? So all of the types of players are buying into the market. I think they feel like that Iran thing is largely behind them. And again, we're into this great April. More on that in a minute. Let's look at the outflows here. There are a little bit of a risk being taken off here in tech. This is Qs, and that's at Vanguard Tech. This is semis. Semis obviously all over the place. A lot of profits being taken there. Soxel in particular. But let's look at the April flows. I just want to point this out because it might arguably be the best month ever for equity ETFs. I'll explain why. So obviously, if you look at the equity ETF flows historically, flows get bigger and bigger as the industry gets bigger. But look at April, you know, right up there, about 135 billion. It's the second biggest month, right? But this month here is December. Now, Decembers have always a big chunk of tax loss harvesting flows, which are not quite sentiment-based. So you could argue, if you lop that off, it was arguably the best month ever for equity ETFs, and the all-time highs that we're seeing reflect that, Scarlett.
All right, good stuff and fantastic setup here for our conversation right now, which is with Maital Legum. She is head of ETF solutions at Teucrim and former director of exchange-traded products at the New York Stock Exchange, where she oversaw the ETP listing platform. So a lot to get to here with Maital. Thanks for joining us here today.
Absolutely. I'm first time here, so thank you for having me.
Great to see you. And I want to start with this idea that you really help issuers launch, manage, and grow their ETFs. So you kind of see them from their inception. You kind of help them figure out their concept and get things going for them. What we're seeing right now is that active ETF counts exceed passive ETFs for the first time ever. Talk about that turning point and what that says about where we are in the ETF industry.
Sure. So, you know, it's no secret that there has been a boom in flows and in the number of funds coming to market in the last couple of years, right? I think over 2,000 ETFs are non-traditional, right? So, you know, Eric was talking about flows and how there's a lot of flows in those traditional passive ETFs, but there's a huge tail of opportunity, right, in the what we call non-traditional space, right? So issuers now see an opportunity, and we'll talk about that, you know, why retail also is helping that, right? I'm an investment manager, and I don't necessarily have a huge army of wholesalers, but I have a great idea. I have a great strategy, right? So it's an opportunity for those boutique RIAs, the crypto native firms, hedge funds, just to kind of dip their toes, and they have a great strategy, but they don't know how to list an ETF, how to trade an ETF, how to manage an ETF, and that's why there's so much demand kind of on my side, what we call the white label firms, because we can help you take this great idea and package it into an ETF, and now you use our economies of scale, our expertise, and everything that we already have set up. Especially for Teucrim, kind of given the history of, you know, the commodity in the future space, right? So we're seeing a lot of issuers or asset managers who are playing in the non-traditional space. There's so much opportunity there. I mean, you saw that 85% are active, but, you know, active means a lot of different things. And fewer, you know, is it really that exciting to list a plain vanilla index fund? Probably not so much. But, you know, with the rise of the retail investors, you know, we've seen a lot of opportunity there.
And so are you the one fielding the incoming calls, getting pitched these new ETF ideas?
Yeah, so, you know, we got a lot of outreach. Some things, you know, maybe shouldn't be an ETF. I mean, I know I'm not in the business of saying that, but like, not everything should be packaged as an ETF, but we do field a lot of those calls.
Well, let me ask you this. For anybody sitting out there who's like, I have a good idea for an ETF, what are you looking for? What would be a deal breaker? What do you instantly throw out? How much of a platform do you need, or like assets lined up ahead of time? How important is the idea? As if you're talking to somebody out there who's considering this.
Yeah, I mean, listen, you have to have something that you're solving for. And also, hopefully, a way in which you know how to talk about it and sell it and pitch it, right? You know, investors are way more comfortable with complex strategies ever than they, we used to say, if it's too complex, no one is going to buy it. We've obviously seen that's not really true. But it's a fine line. But are you solving a problem? Is there a demand? And do you have a target audience?
No, I think that's a really interesting point about complexity, and I want to pick up on it. Why do you think it is that complexity is winning out over simplicity? I don't
know if it's winning out in terms of assets. I think it's people are seeing an opportunity, right? So the large established managers, they're going to gobble up all those assets in the plain vanilla, but there is so much opportunity in that tail, right? And it seems to me like retail investors especially, and people are more comfortable in the ETF wrapper, right? The ETF wrapper has become something that people are really comfortable with. So now they're even comfortable with things that 3 years ago we would never even imagine could fit in an ETF.
Yeah, I mean, I can take a stab at that too, Scarlett. The buffers to me are very complex, but the outcome, it cures anxiety. Some of these ETFs are like pharmaceuticals, in my opinion. They're actually solving psychological issues. For boomers, they're curing anxiety, right? And for young people, they're giving you an adrenaline rush with the triple leveraged in crypto, right? So is that what you're looking for? Like, does this thing do something psychologically to the end client? Because I agree, the ETF is now so trusted that they will not even open it that much. They'll be like, okay, I like the outcome. I don't need to know exactly how it works.
I mean, I agree with that to an extent. I mean, I think it could be twofold, right? You could either solve this anxiety issue, which I like how you put that, but also maybe you're just adding building blocks to your portfolio, which historically, you used to go to an advisor to that, but now we've seen Gen Zs and millennial. I think I saw a stat that said like 8 million people are going to be buying their first ETF in 2026. Don't quote me on that, but something like that. And now there is an opportunity for maybe a more traditional ETF as well, if you have the right brand and you kind of like hit the right stride. So I was shocked, right, in terms of like some of the thematics that are in vogue now, which if you would have asked me 2 years ago, I'd be like, why would you list a thematic ETF? But listen, they are doing really well.
So, Maital, I got to ask you a question. Our Katie Greifeld noticed that there's a lot of folks who were at the New York Stock Exchange or other traditional exchanges, SIBO, NASDAQ, for instance, have left and gone deeper into the ETF industry. You were at the NYSE for 14 years. Is there kind of a brain drain going on here?
No, I think the ETF industry has grown so rapidly, and there are so many opportunities, and there's so many people looking for talent. So when you sit at the NYSE, you really get to speak to everyone, and you see so many things. I mean, like in many different variations, and you see, the whole ecosystem. And I think people see that as something that is really beneficial that maybe they can bring to their firms. So, I think the exchanges over the last 10 years have had, tremendous success. They worked really hard to, on the cryptocurrency and in the generic listing standards, both, 6011 and the ones from the fall for the cryptos. But, things are starting to move. And I think it's become a little bit easier to list an ETF from an exchange perspective. But I think it's just people are looking for talent, and that's a really easy way to find it.
All right, that says a lot then. Maital Legum, thank you so much, of Teucrim. Thank you so much for joining us today.
Oh, absolutely, thank you.
Coming up on ETF IQ, we're going to speak with Sean O'Hara of Pacer ETFs to discuss the NASDAQ International Patent Leaders ETF. It's a good one. But first, this week, we spoke with prominent ETF voices, including the CEOs of Janus Henderson and State Street at the Milken Institute Global Conference. Here's a sampling of what we did here.
Outside the U.S., there's still a liquidity need that people have. So in Europe, in Asia, where I was last week, in the Middle East, in Latin America, people are really starving for an ETF, easy to trade, platform. And again, we want to be the providers of that. People don't know that we're the third largest provider of active fixed income ETFs in the world.
Part of what you have to look at over the last decade is what's happened to ETFs, right? ETFs have exploded. Like I said, it's the vehicle of choice.
This is Bloomberg ETF IQ. I'm Scarlet Fu, and it's time for today's drill down, where we focus on one singular ETF. Eric, what do you have?
Today, Scarlet, we have patent. This is PATN. It's the Pacer NASDAQ International Patent Leaders ETF. Essentially, it's the NASDAQ 100 for ex-US stocks, more or less. It looks through the ex-US universe, looks for things like intellectual property, not just number of patents, but patent value, research. So it's trying to get you like really good R&D type companies that are on the innovation front. 65 basis points. It's got 84 million, came out about a year and a half ago. Let's look at the cross section of what it holds. So you can see a little bit about where we're going. So we're going to see it's a lot of Asia in here. You can see a lot of Japan, Korea, Taiwan, right? So a little more heavy Asia than Europe. And let's look at the performance here based on the compared to the Qs at home, right? So we have QQQ here, SPY and EFA. I put EFA in there because it's an international ETF. And honestly, patent is crushing them. I mean, this was obviously international had a good run. That helps. But it's all beaten EFA too, which is international. So something's going on in here that's very good for now, Scarlett, and this should help get it some looks.
All right, thank you so much, Eric. Joining us now to talk about PATN, this ETF, is Sean O'Hara. He is president of Pacer ETF. So this is really NASDAQ, but without too much of the United States, because the U.S. only makes up less than 10% of this fund. It feels like it's very Asia heavy.
Well, let me just start with the premise, okay? So we have a great relationship with all the index providers. We work with, S&P, NASDAQ, FTSE Russell, and so forth. But we don't work with them in a traditional sense. We try to customize a lot of things, and they'll come to us from time to time with ideas. And in one of our meetings with the folks at NASDAQ, I said, why isn't there a NASDAQ 100 for international? And they said, nobody ever asked us that. So I said, well, why don't we build one? And so we went through a whole bunch of permutations, and then they came back to us and they said, look, what makes the NASDAQ is innovation. You see their ads all over television. And they work with this company called IPR that measures the patent value of companies, so the relevant patent value. And that's where innovation comes from. And so we built this ETF together with NASDAQ, where we used their screen, IPR screen, to identify the 100 companies out of their NASDAQ Broad International Index that have the highest patent value. And we rebalance on a regular basis to adjust as there are changes. International investing has been hot. I would say that for most people, you need to be aware that it's been a lot of currency, right? And a little bit of multiple expansion, to be honest with you. The challenge with investing in internationally is that you have to buy the international stocks. And there's this thing that somebody said to me once, that there's two vibrant economies, one in the East and one in the West, and there's this giant museum in the middle, and that's Europe. And so when you invest in a broad-based international index, you have heavy weights to slow-growing sectors. You got massive overweight to financials. And this solves that problem. We're investing in companies who are innovative and driving that innovation. So you're going to see a shifting of the sectors. No financial exposure, lots of tech, lots of pharma, lots of consumer brands. And so for me, as somebody who's been watching this battle go on forever, as how much should we have in international investing? And every time we do it, we say, gosh, I wish I didn't do that, because the end result doesn't necessarily work out. This is a completely different approach that's focused on identifying companies that have that characteristic that NASDAQ says is so important, which is innovation.
Yeah, this has been a whole thing. Like, is there innovation overseas? It reminds me of that phrase that I heard about a year ago at a conference. America innovates, China imitates, and Europe regulates.
Yes.
And that's part of why it's been tough to capture an innovation factor over in Europe especially. But you can see Japan, South Korea, Taiwan, Asia is very heavy here. What would you say to somebody who has seen this movie before, where international has a good year, and then the U.S. just takes back over? Why bother?
Well, because it's different, right? I'm not just weighting the ETF by whatever the sector weights are across these different countries. I'm specifically trying to target companies that we believe over time will have better growth than the broad index. And some of them might be in Europe, and there are names in Europe in here. But the names that we're going to own here internationally are names that are going to rely on that innovation, that patent value. And so The U.S. is being driven by the AI tech boom here and has been forever. And we look at the names here, there's many of them that are participating in that AI trade. You got ASML, you get Taiwan Semiconductor, you got some memory names in here on the software side. So you got Toyota, which is a car maker out of Japan. And so what's different about this, I'm not going to say it's different this time because those are bad words to say because we always get proven wrong. But what's different about this is its approach. It's not just saying I'm going to invest internationally because I was told I need to do that for diversification purposes. I'm going to invest internationally here with an intention to identify companies outside the U.S. that are more like the innovative companies inside the U.S.
How do you manage the currency risk then, given that so many of these companies are based outside the U.S.?
We don't hedge the currency at all. We get some benefit. Let it fly. Just let it fly, because that's part of the diversification thing. Like if you're a U.S. investor, you should probably have some diversification for your currency, and the easiest way to get that is to own international stocks. Sometimes it works in your favor, like it has lately, so the dollar's been dropping, so we're getting a little bit of a tailwind. Sometimes it works the other way, and it becomes a headwind. But by and large, what we think we own here are stocks that, in general, over time, we think will grow faster than a pure international index that has a 24% weight to financials and all these heavy industry sectors.
I do notice some European companies in here, Novartis, among them Roche Holdings, Eric, Nestle, as well as Siemens.
Yes.
Yeah, no, they're just few and far between.
Compared to the ones in Asia.
If not for Asia, this probably wouldn't work. But anyway, I wanted to pivot real quick. Pacer.
Yes.
You guys are almost like the cow company now.
I wish, yeah.
I'm looking at your top ETFs, CALS, GCOW, and CAF, right? These are cash flow ETFs. You basically made these ETFs on one metric, huge hits.
Yeah.
What's the case for them now? Because they kind of cooled off a little bit. What would you say to somebody who's like, man, are they going to work going forward?
Well, what I would say is that the last couple of years, momentum and low quality have worked. So if you look at small caps in particular, the 30% or 20% of the stocks in those small cap indexes that have the lowest free cash flow yield, for example, which means they don't have any free cash flow and they don't make any money, are up tremendously. That's just an anomaly. And so these cycles happen from time to time. We work with empirical research. We've got lots of data on this. That shift is starting to change now. And I think what's causing that shift is this fear that we all have that the hyperscalers are going to spend all this money and they're not going to perform as well. And so there's been a little bit of shift to quality. So CALS has come back nicely this year. CAF is coming back to over 30% the last 12 months. So if we're going to have a rotation to quality again, and we're not going to just rely on momentum and low quality, then I think there's a good case to be made for CALS, CAF, GCOW, all of those things that have been our sort of major brand, if you will, over the years.
Now, Pacer is based on a horse, right? It's a horse.
Yes, the year of the horse.
No, but are you going to change it to a cow?
No, we're not.
The logo?
No. My partner is in the horse business.
You might as well run with it, I think. No pun intended.
He's in the horse.
Cows don't really run, do they?
Yeah, well, we like the cows. We like the free cash flow, and so we've sort of done lots and lots of different versions. We use cash flow for growth is free cash flow margin, but if we're going to have a shift back to reality, then having something like cows, and you can see the start of the green shoots of that shift changing in terms of performance, is probably a good time to start looking to move back in that direction.
I love the linkage with hyperscalers, and they're using up their cash flow right now to build out those AI infrastructure data centers. Sean, thank you so much for joining us today. Sean O'Hara of Pacer ETFs. And you can read about this drill down plus the latest in the ETF industry when you subscribe to Katie's weekly ETF IQ newsletter. It's available at bloomberg.com/ETF IQ newsletter. Now, still ahead on ETF IQ, the television show, we look at the risks of one precious metals ETF through our Bloomberg Intelligence traffic light system next. This is the ETF IQ.
I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. stocks have turned lower on the day, now hitting session lows as traders look for updates on a potential U.S.-Iran peace deal. The U.S. is waiting on Iran to respond to its proposal to reopen the Strait of Hormuz and end a nearly 10-week war, with tensions still elevated across the region. Meanwhile, oil is pulling back, with Brent and WTI both slipping below $100 a barrel, as traders price in the possibility of an end to the conflict. And in corporate news, Citigroup shares are reversing early session losses as investors sort through the bank's long-term targets that suggest a slower path to catching up with peers. The rebound may reflect dip buying, and some expectations were already tempered. Bloomberg Intelligence noting some conservatism likely baked into Citi's capital outlook. The bank forecasted returns of about 14% to 15% by 2031, a level some analysts call, quote, underwhelming. And finally, Datadog is soaring, on pace for its biggest single-day advance since 2019. That's after the company's first quarter results beat expectations and it raised its full-year forecast. Those are your midday movers. I'm Nora Melinda.
It's time now for our metals spotlight, and today we focus on a metals ETF through our Bloomberg Intelligence traffic light system. Eric, who designed the traffic light system, is here with us. Eric, what do we have?
Today we're looking at glitter, GLTR. This is an interesting one. So this holds the 4 big precious metals physically, right? People like to invest in that. So it's gold is 57%, silver is 35%, platinum and palladium are 3% each. The reason people like these metals is that they are physically, there's no contango or roll costs. You don't use futures. These you can store physically. So there's no weird roll costs. So it doesn't get any dings for that, like
so
other
it should be
commodities.
Green light.
No, here's why. First of all, when you hold a precious metal like gold or silver, you get taxed as if you own like a commemorative plate, like it's like a collectible.
Really? Okay.
Yeah, it's a weird taxation and it can be a little weird for people. It's not that big of a deal, but you need to tag it. Now the premium discount issues, you will see the price of this sometimes veer away from the NAV a little more than normal, but it's not really totally a bad thing here. The ETF just uses the gold prices in London at noon. So the NAV is set at noon. That means the price can actually trade a little more if gold or silver is coming up. So I wouldn't hold it against the ETF. But again, those are 2 things to look out for. Otherwise, the reason I thought this interesting ETF is this ETF is $3 billion. That's pretty good. But it's only like 1% of all commodities. This is why I don't think crypto basket ETFs are going to be that big. I think people are going to buy Bitcoin like they buy gold, Ether like silver, and then maybe some people will basket the rest. But this is a good example of why just packaging it all in one shot may not work when you get to things that don't have cash flows.
Absolutely, because you're looking at this ETF, which has 4 holdings, as you said, and the 2 biggest holdings, gold and silver, make up the lion's share, more than 90%. So you don't really need palladium and platinum.
Also, most people just like gold. They don't need the rest. Silver's kind of niche, and the other ones are really niche.
Yeah.
The traders like that stuff, but the traders want it unbundled because you lose volatility by packaging it. So I think the same thing will play out with crypto. I think the baskets will underwhelm.
All right. They're certainly coming out with every variation of crypto ETFs under the sun. I mean, there's already several Bitcoin-only ETFs, and then they've got to add all the whistles and bells.
Yeah, not to mention crypto picking ETFs from T. Rowe Price coming out in a couple of weeks. That should be interesting too. But yeah, I don't know if the baskets will be as popular as people think.
All right, we'll see how it all shakes out. Eric, and thank you for that. And of course, you can check out the traffic light system on your terminal at BI ETF Go. Coming up, our exclusive interview with San Francisco Fed President Mary Daly. Coming up next with our Michael McKee. This is ETF IQ on Bloomberg. Many ETF investors, of course, watching the Fed during a transitional period and a round of higher inflation. So let's go now live to our San Francisco bureau, where our very own Michael McKee is standing by with an exclusive interview with the San Francisco Fed President Mary Daly. Mike?
Well, good morning from San Francisco, and thank you very much to all our listeners and viewers around the world, and thank you to Mary Daly for joining us today. I have to start off by saying, after we had the Fed decision, Bloomberg had on a Wall Street analyst who said, the important thing now is to find out what Mary Daly thinks, because she was kind of on the dovish side, and yet she's not an extreme dove. So I want to get your feelings on it, and the story was the dissenters on the bias for the forward guidance. Would you agree with their position? You weren't a voter, but did you agree with their position?
You know, I don't see a lot of confusion in the public. When I go out in my communities, talk to businesses, talk to consumers, households, I don't see a lot of confusion. They know the Fed is committed to price stability, that's our first priority right now. The labor market is stabilized. They see that from the adjustments we made last year. So for me, it's really about the right policy decision was the one everybody agreed to, which is hold the rate steady, continue to collect information. And you see in markets pricing even today, markets have priced in, equal probabilities of a cut versus a hike, and the most likely probability is that we hold steady. And I think that's well positioned. So for me, the real signal about the meeting is that everyone agreed to the decision, and that the communication that the chair made in his press conference is, higher for longer relative to last year, but the households, businesses, and markets had already priced that in.
Your colleague from Boston, Susan Collins, told us yesterday that the phrase about additional moves is associated in people's minds with a cut now because it's been following so many times. Do you still feel that that's the path for monetary policy?
It's sometimes sad for Fed officials to realize this, but there are very few people other than all of you and Fed watchers who look at our statement. Most people look at how we position ourselves, and there I would say that most people aren't worrying about that phrase. And so I think the phrasing of the statement is less important than the actions of the FOMC. And the actions of the FOMC have been to really focus on price stability when we think inflation is rising, and really focus on being patient enough to see if the concerns we have are even going to materialize. So it all comes back to how long does the conflict last? And if it's prolonged, then we might see more spillovers of oil and other commodity prices into other goods and services. And if it comes up quickly, it ends soon, then the forward contracts on oil are for oil to come back down to around $75, depending on the day. And that is something where our businesses are telling us, oh, we're looking through the shock right now because we don't think it'll last forever, but it won't be forever that we can look through it. And consumers are doing the same. Look at the spending. They're mostly looking through.
But policy-wise, is the cutting cycle over now?
I think it's really too early to tell. If the conflict ends and oil prices come back down and that doesn't get passed into the broader economy, then I expect the underlying dynamics that we were facing prior to the conflict to return, which is policy is slightly restrictive, continues to put downward pressure on inflation. The labor market is stable right now, but it's not creating any inflationary pressures, and businesses are cautiously optimistic. So that's a good dynamic for the economy, and one where I expect inflation to come back down to our 2% target. But the main issue is, what is the risk out there? How does the oil price shock, move its way through the economy? How long does the conflict last? And can we really get that 2% target that we've been working towards? That's what we're determined to do, is achieve that.
Can you get to that target? The Fed watches inflation expectations. The New York Fed survey of consumers today showed inflation expectations rising to 3.6% for the next year. Are you in danger of having those become unanchored?
The short-term inflation expectations are a reflection of what people are feeling right now at the gas pump, in the grocery stores, et cetera, as fertilizers and other things start to spill over. That is not something that indicates a drift of the anchor. What we really have to focus on is, does that translate into a move in medium-term inflation expectations or longer-run inflation expectations? You really don't see that right now, but that's not satisfying to say we don't see it, so it's not there. You have to dig deeper. What are we really seeing in terms of wage negotiations? What do we see in terms of firms passing along things? So I spend a lot of time, as you know, going around the 12 districts, and I just don't find a lot of producers and sellers feeling like they can pass through the price increases to consumers and have consumers stay in the game. So you're seeing some surcharges emerge on energy, but other than that, you're not seeing a lot of pass-through as of yet. So I think the economy's in a place where I wouldn't jump to the conclusion that we're going to have persistently high inflation. I would jump to the data and say, what can we see? And the inflation expectations being well anchored is an important component of our ability to be patient.
Well, we've been largely talking about energy inflation here. Tariffs are still on. And according to the administration, there are more coming within the next month or so. What are companies saying about how they're dealing with this now that they're a year into it?
Well, right now they're trying to get refunds if they're eligible for them, and they're working towards that. But they didn't, not all of them passed through the full tariff burden. They split it up on things, and they see those burdens as rolling off. That is more or less coming back to normal. You know, tariffs are a one-time price adjustment, and they calculate how much can I take out of margins, how much can I share with other producers, how much do I need to pass along to consumers. So I would say that's in train and moving in the direction we had anticipated. The new information is that we've got an oil price shock added to that, while inflation has been elevated since, you know, for almost 5 years. And so consumers are just feeling the ongoing pressure of dealing with higher price levels and inflation that's above our target. So, you know, the way I think about that is we have to continue to work towards restoring price stability, but overreacting to the news or an expectation that something's coming down the pipe can be as damaging to the economy as underreacting. So you have to balance both of those risks and really watch the information that we have, not just the backward-looking information about what inflation did last month, but the forward-looking information about how consumers, producers, and sellers are really responding to the challenges ahead of them.
Well, Chairman Powell in his news conference suggested that there is a concern, or at least he has a concern, that after a number of supply-side shocks in the last 5 to 10 years, consumers are no longer thinking that 2% is normal.
Well, that's what we have to treat, absolutely. So there is this whole concern, and it's in the research literature, et cetera, that you can only put so much pressure on the goal. If we print higher and higher above the goal, that actually bleeds into people's expectations. So that's one of the things I think is really important to study. I know we're both going down to Hoover tomorrow, and it's going to be a topic of conversation. It's a focus of my research team's work and the research I think we're doing in academia to really think, does this bleed through? But for now, what we're doing is looking at all the other information and asking, has it happened? And I don't see a lot of evidence in the data that longer or medium run inflation expectations have drifted off the 2% anchor. And certainly wage inflation is consistent right now with the 2% target. So, you know, it's right to look, it's right to study that, it's right to ask the question. You can't jump to the conclusion that just because it might be true, it is true.
You'll have a new boss next, not boss because of the way the Fed's set up, but a new chair next week probably.
My fifth chair, by the way.
Congratulations. I'd like to run through a number of Kevin Warsh's ideas and see what you think of them. And the first one is a smaller balance sheet. And there are two ways of looking at that. One is just to bring the balance sheet down and use various ways to ensure there's liquidity. And the other is to go back to a scarce reserve system. How do you think about either one of those?
You know, it's interesting. I think this has been a topic for a long time that is really important for us to grapple with. The balance sheet comes with optics that are hard to control, and people worry about the footprint, et cetera. And so, you know, I gave a speech back last year on how do we communicate the balance sheet, whatever it is. The truth is, you figure out what you need to do, and I think providing liquidity is an important component. We don't want to risk, you know, businesses like we did in the financial crisis, not being able to get liquidity even though they're well capitalized simply because they didn't have that counterparty. So that's scarce liquidity is just a challenge for the financial system. But there are many ways to provide liquidity without actually, you know, being in the situation we're in. And I look forward to working with Kevin Warsh as chair and also all my colleagues to really think through that. I think the thing that the American people should know, your listeners should know, is there's two components of balance sheet policy. One is the plumbing. How do you actually do it? And the second is the explanation. How do you explain what you're doing, and how do you ensure that markets understand where you're going with the balance sheet, that that the public understands why it's growing or shrinking, and that ultimately we're putting those two things together. The ECB does a different thing. They have ample on demand. We run an ample on supply. Certainly, we can consider those types of things as well. So I'm in the point of it's a good thing for us to study. And I don't want to prejudge the conclusion because there's a lot of work we can do to figure out what the optimal way to do it is, not just from the plumbing, but also from the communication.
What about the SEP, the dot plot? You have moved to talking about scenarios rather than exact forecasts. Is that something the Fed should do?
Well, you know, again, I'll leave it to the deliberations we take at the FOMC. But I do think scenarios in a time when you have a lot of shocks coming your way are really important. You know, the strict forward guidance, and this goes all the way back to Bernanke and predates him when he was an academic, not the chair, is that, you know, the idea that you're going to provide a lot of precision when you have a very uncertain future is just, it's a false precision. We don't have it. So then what do? Well, then scenarios can be helpful because they help the public understand what is most critical to understand, the Fed's reaction function. There are point estimates about what we think will happen in a month or 2 months or 6 months, and then what we would do if it happened. Those are much less interesting.
Would you get rid of the SEP? Would you get rid of the dot plot?
I am, you're going to be dissatisfied with this, Mike, but I'm going to say that I think that I look forward to deliberations on all of these topics. Ultimately, the Fed's communication has to, and I've talked about this many times, transparency and communication are critical to having an accountable Federal Reserve. And how we communicate should be studied, maybe change to meet the moments that we have in front of us. And I think that's the real evolution I'm looking forward to. But I don't want to prejudge or stake out any territory about my thinking until we all have a chance to deliberate it collectively.
Okay, one last question. Kevin Warsh has suggested that you all talk too much. There's too much Fed communication. What do you think of that? And would you be willing to cut back on communication except when doing interviews with us?
Yes, this is what everybody's going to ask us. But the thing that I think is really important is to ask ourselves, why do we communicate? What are we accomplishing? Here's how I think of it for myself. We're trying to explain what our reaction function is and why the policy choices that we're making or thinking about are really for the American people. What variables are we thinking about, et cetera? And you know this because it often causes dissatisfaction, where we're going to go next week, what my thinking is today is much less relevant about the point estimates on the policy decision. What's much more important is how would I react to economic situations coming forward. So again, I look forward to having Kevin Warsh, when he's confirmed, having him join the FOMC, having him chair it and lead it. And I also look forward to the debates that, I know Kevin well enough to say that he does mean what he says when he says he wants to have real debates, real discussions, and I look forward to those.
Well, we look forward to you continuing to talk to us, even if Kevin says you can't talk to anybody else.
We'll see how that goes.
Mary Daly, the president of the San Francisco Fed, thank you very much.
Thank you.
And we'll send it back to you.
All right, our thanks to Bloomberg's Michael McKee in San Francisco with the San Francisco Fed President Mary Daly. While she was speaking, we saw the 2-year yield move up. It is basically at session highs right now. As Mary Daly says, if the conflict in the Middle East ends, the prior positive dynamics could return. Again, the 2-year yield at session highs, 3.89%. Coming up on ETF IQ, we speak to Brittany Christensen of Tidal on the new way distributors are monetizing ETFs. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu. Fidelity and Schwab are now making asset managers pay up for certain ETFs, up to $100 at a time. Joining us now is Brittany Christensen, SVP Head of Business Development at Tidal Financial Group. And Brittany, this goes to the idea that Fidelity began doing this in November 2025, where it charges shelf fees for certain ETFs, usually from smaller issuers. But now Schwab is doing the same. What's going on? What was the thinking behind this?
Yeah, absolutely. You're right, Scarlett. ETF fees are going through a course correction. Active ETFs changed the product mix, but distribution economics didn't evolve alongside the active ETF growth. The industry needs scalable solutions, not manual processes that become more expensive as volume grows. And so I think ultimately overall, we will see certain things come in the distribution fee structure that is a result of the growth of the industry and the pure man hours that go into essentially supporting 5,000 plus ETF products.
All right, so for an issuer, the idea here is you need to give us a taste of the revenue or pay us to get shelf space. But for a user, let's go over through what this looks like, because let's say you're looking at maybe a not popular ETF, you're going to buy it, Fidelity is going to hit you with a $100 trading fee unless the asset manager pays them. And how do you watch out for that? What would you tell a retail investor to watch out for here?
I mean, I would tell the retail investor that it's going to become more important whose brand of ETF that you're using, right? And so understanding that there has been a lot of players who've negotiated revenue sharing agreements with Fidelity to prevent their ETFs from having that fee structure. But there are other ones out there, maybe smaller players or new ETF shops that haven't paid that structure yet. I think there's still ongoing conversations with both Fidelity and Schwab, who are important parts of the ETF ecosystem, regarding what we can do to not disincentivize some of the startup players entering the ETF space, or having kind of newer funds maybe have a little bit more of a runway. But I do think it's interesting, Eric, that the SEC hasn't jumped in to protect any of the retail investors who are potentially exposed to some risk that they aren't entirely used to.
Yeah, no, I agree. Because with the screenshot I saw, it looked like it was not clear you're going to pay this extra fee. So definitely. I also find it interesting that if you're like Vanguard and you're so popular, you can kind of just get a pass here, right? Like, is that what's happening to the bigger issuers? Like, even if they don't pay, they're just going to let them on because otherwise the platform would lose value if you don't have the big ones?
I mean, I think that's partially what you're seeing, Eric, but I also think it's interesting to kind of follow some of the bigger issuers in launching their own proprietary products, right? So you're seeing BlackRock and State Street file for NASDAQ 100 ETFs, who's to say Fidelity and Schwab, who are in and of themselves their own issuers, don't do similar things, right? So I think that's still yet to play out. If the big players will get by. What I do think will happen is that you're going to start to see the fee ranges of new product coming to market, baking this in, essentially giving them a bit of a, let's call it, more wiggle room to use to pay these fees, whereas your legacy shops who've been in the space for a long time are sort of out of tools unless they start, unless someone decides to trigger a 12B1 style response. And be the brave ETF issuer to do that first.
Oh, interesting. So it's not just the expense ratio people need to watch out for, but this $100 fee, and then in the future, maybe the expense ratio will kind of encompass this as well. Why now? Why did Fidelity choose to do this now and step it up? And why is Schwab following? I mean, what has changed for them to move forward with this?
I mean, I think it's largely the migration of assets out of the mutual fund wrapper and into the ETF, right? It's ways they've used to monetize their distribution capabilities has been upgraded into the ETF wrapper, which didn't come with the same distribution payoff structure. And so I think where they're at is trying to understand, we've had this massive reduction in our revenue numbers because of ETF growth. If we're not here to stand in the way of the ETF industry expansion, then how are we also going to be able to make up enough money to support it?
Okay, so they need to make their nut somewhere, and this is one way of doing it. Brittany, thank you so much. Brittany Christensen of Tidal. This is ETF IQ on Bloomberg. All right, this is my favorite part of the program, where we have an IQ test where Bloomberg's Joel Weber is going to see whether Eric and I really know our stuff when it comes to ETFs. I think we know the answer here. Joel is the head of games here at Bloomberg, and Joel, you spent a lot of time crafting these questions.
Yeah, I love that this is your favorite part of the program, where I get to torture you.
It's a little embarrassing and it's humbling.
Eric's winning though, too. Okay, all right. Well, we've got 3 questions for you, and this week it's themed. The theme is hedge funds. So, question number 1. These all come from James Seifert in Bloomberg Intelligence.
Okay.
Which hedge fund holds the most assets in ETFs? Scarlett, over to you. This is all based on Bloomberg Intelligence research that you can find on the terminal list.
Okay, I'm going to go with one that I didn't expect and say Marshall Wace, B.
Okay, that's B. Eric, what do you think?
I'll go with A, Citadel, Ken Griffin.
Okay, the answer is B. Scarlett is up 1.
Sometimes,
I love this. Yeah.
Sometimes you get one.
All right. Okay, question number 2.
This is unusual.
Sticking with hedge funds. Which hedge fund holds the most ETFs? Is it AQR, Citadel, Gotham, or 2 Sigma? Scarlett?
I'm going to go with 2 Sigma.
Dart at the dartboard. What do you think?
I'm going to double down on Citadel.
Citadel? Okay.
Ken Griffin has to be in the answer somewhere.
Okay. That's correct. B.
Okay, good. Thank you.
All right, so we're 1-1.
Okay.
Tiebreaker. Let's see.
All right,
we can get question number 3. Which ETF recently unseated SPY as the most popular holding among hedge funds? Invesco QQQ, IVV, VU, or IWM?
I'm going to go with IWM.
I'm going to go with IVV.
Okay, so we got B and D. Let's see who it is.
Oh,
Eric ekes it out at the finish line. All right.
Last minute shot, unlike the Sixers.
Why do they care about the cost?
All right.
Well, IVV's 3 too. And it's more liquid.
All right.
All right.
Well,
Cheap
if you
plus
like
liquid.
if you like playing games, go to Quiz Go on the terminal for more, and you can also play Pointed at Bloomberg.com/pointed, where you can play around with some leverages and points.
Where's the leaderboard for ETF IQ?
You know,
You don't want to say it.
I don't know. We'll,
I mean,
you know
we already
what?
know who's in
We
the
will
lead.
revisit that, and we'll come back to it, and we'll see what it is.
Okay. All right. After I win a round or two. Joel Weber, thank you as always. And that does it for this week's Bloomberg ETF IQ. I'm Scarlett Fu with Eric Balchunas. We will be back on Monday with Katie Greifeld. From New York, this is Bloomberg.